The Monetary Policy Committee of the Bank of Uganda has maintained the central bank rate at 9.75% for the month of February. The decision followed a critical assessment of both domestic and global economic conditions, according to the Governor, Bank of Uganda, Michael Ating'i.
The MPC kept the central bank rate unchanged at 9.75%. The CBR band at plus minus 2 percentage points, with the rediscount rate and the bank rate set at 3 and 4 percentage points above the CBR, respectively, resulting in a rediscount rate of 12.75% and a bank rate of 13.75%.
Inflation has maintained below the medium-term target of 5%, reflecting the impact of prudent monetary policy, coordination with fiscal policy, a stable exchange rate, declining global inflation, and favorable food and energy prices. Despite a moderation in economic growth in the 2 quarters to September 2025, high-frequency indicators and forecasts point to stronger economic activity in the quarter to December 2025 and in the second half of the financial year.
So our monetary policy is very strong. And what do? We have very strong tools. The tools, we can't explain them here and extremely technical, but we have very strong tools that manage money supply. And you have seen that even during elections, it is very unusual. It is extremely surprising that even on the day of election, our shilling instead gained.
Current monetary stance adequately addresses all the issues in terms of allowing sufficient monetary growth, while at the same time making sure that there is no inflationary pressure arising from that.
However, risks to the inflation outlook, both upside and downside, remain elevated.
On the downside, risks include a sharper than projected slowdown in domestic economic activity, a deceleration in global growth stemming from trade-related shocks and heightened uncertainty, and a decline in commodity prices with these inflationary effects.
Over the medium term, economic growth is expected to strengthen further, rising to an average of around 8%. This outlook is underpinned by accelerated public investment, oil-related and infrastructure development, governmental initiatives, improving global economic conditions, prudent monetary policy, and increased private sector activity. Dennis Igoa for UBC.